Excellent. Well, thank you so much for joining us on the call today. We've got a lot to talk about. Obviously, the market has been pretty volatile here over the last month, and we'll go ahead and go through a few things here. Just addressing that and talking through that, and hopefully bring some clarity to you as well. One thing I would ask, if you have the possibility of muting your phone, please do, and it'll just help cut down on a lot of the background noise. All right, the first chart that we have here is of the S&P 500, and also it's the Fed's balance sheet. And we've been saying this for a while now, that we are of the belief that what has been pushing the stock market higher has been the actions of the Fed with the quantitative easing and liquidity and buying of the assets and the things that they're doing. And, this is going back to the low here in '09. And again, if you notice, the market and the size of the balance sheet are pretty much moving in line with each other. And if you actually ran the numbers, it's got a correlation coefficient of 96.89, which 100% is basically right in line. So these are very correlated with each other, and as we all know, this tapering is going to actually it ended this month. So there's no more, the balance sheet will not be increasing anymore, but what they are going to do at this point is just maintain the size of the balance sheet. So it'll probably just move sideways here for a while. They'll still have to buy securities, because the majority of the securities the Fed owns are mortgage backs. And as you know, every time you pay your mortgage, you're paying a little bit of principal and interest. So in order for the Fed to maintain this level, they will have to buy a little bit every month, just simply because some of that principal is going away, as folks make their payments on their mortgage. So no plans yet to increase this, but this is really the big million-dollar question here. We had the first correction, came back up. How is the market really going to respond here as the quantitative easing stops? Now, the thing to keep in mind, though, is that this size here is still about $4 trillion of money that the Fed has injected into our economy. So that's not changing. So even though they're not increasing their balance sheet anymore, there's still $4 trillion that are out there, readily available to be lent, to be, whatever, in terms of keeping interest rates down and liquidity out there. So this, this could react the same way as it does in the past, where we've seen some of these corrections. Again, we're not sure, but if history is a guide, we'd say that we're probably due for a little bit of volatility, just like we have been here over the past 4 or 5 years. And that's what this next slide kind of shows as well, is that, coming out of the low of '09, you had the first quantitative easing program. It ended. You had a 17% correction in the market. You had the next quantitative easing program. It ended. You had a 20% correction, then a rally, a 10% correction, and then it was really the end of 2012 that the mother of all quantitative easing started, QE3. And if you notice, during that period, you had very small corrections, 7.5%, 6%, and really up until this one that we're in right now has stopped, we really got our first, if you rounded that up, it'd be about a 10% correction right there. So obviously, Fed policy is affecting the stock market here, and I'll show you a little bit later here too why we believe that as well. A couple other things that we're seeing right now. We're of the belief that we like to say that the smart money is in fixed income, and if you look here. In these fixed income markets, and we're going to look at two here, what we'll do is we'll take the fixed income market that we're looking at, and that's the gold line here, and then we'll take the 10-year Treasury. And what we tend to do is we want to measure the difference between the two. We call that the spread. And what that tells us is that if the spread is widening, investors are, what we like to say is they're avoiding risk. They're taking money out of riskier investments and moving it into less risky investments. And if you notice here, since this summer, now this is high yield debt. So this is high yield debt is high yield's a pretty name for what we call junk debt. These are companies that have poor credit quality, but these are typically your smaller companies that are, you know, they're new, they maybe not be as, they're not established, so you know, they're typically paying a little bit higher in interest than, let's say, like a GE or a Microsoft or something like that. But again, if you notice, most of the past few years, this spread has been narrowing. So, you know, as the markets moved higher, as interest rates have stayed low, investors have been willing to buy up this debt, and it's really driven spreads pretty low. Really, up until this summer was the very low here. The spread was, you know, maybe around 250 basis points, which is pretty low over a AAA rated Treasury. But what's been happening here over the past few months is that spread's been widening, and we would say that if the spread continues to widen, you know, that typically doesn't bode well for the stock market, because that means people are retrenching, they're pulling money back. Now, we're evaluating the most credit risky part of corporate debt. Let's look at this next part here. There we go. Now this is just corporate, so this is more investment grade. So this includes the GEs and the Microsofts and the things like that of the world. And as you can see, now that spread got all the way down. That was end of last year to, geez, not even, you know, maybe 30 basis points. So I mean, they were almost trading right in line with Treasuries. And as you can see, really since that low this summer, it's expanded up to about 75 basis points. Again, if this spread continues to widen, you know, we're going to want to be, you know, in a more defensive posture when it comes to stocks, because again, you know, the debt market trounces the stock market when you look at, you know, dollar-wise, notional principal, things like that. It really is what's driving the vehicle here, in our opinion. So we're looking at sectors here, utilities on the left, healthcare, technology, all the way to energy, and this is simply just their performance from the beginning of the year to the close on yesterday. And well, yeah, well, that's actually November 5th. But you get the idea here is that these have, you know, what have been the best sectors that have outperformed? Utilities, healthcare, technology, staples. You can make a case that these tend to be maybe more of your defensive areas. What are the worst areas? Energy, cyclicals, materials, industrials, financials. You can make a case that these are more your economically sensitive areas. So, you know, even though the market is up this year, what has been outperforming has been the groups that, again, are more defensive. So, you know, the groups that are underperforming, ones that are more economically sensitive. If this was 2013, we would see, you know, like cyclicals had a really strong year, industrials had a really strong year, financials were strong, technology was strong, maybe some of your more cyclical names were stronger, but that has not been the case this year. Now, taking that a step further, what I did is I ran the same performance here, but I took it from our most recent low here on October 15th. And it's really been a mixed story. So the good news is, coming off that low that we just had, everything has participated, okay, so that's good. But, you know, again, probably your stronger areas here are still utilities, healthcare, technology. You know, the two that have really kind of popped up here recently that we've been most surprised at is just the strength in industrials, even financials some. Your materials, cyclicals, and energies are still underperforming the market. So a little bit of a mixed bag, not too much, I would say, to draw from this, but it's still somewhat, I think, supporting our thesis that the defensive areas are still a place to be. This is just another example here of looking at that. This is an ETF that tracks an index. It takes stocks in the S&P 500, and then it qualifies certain ones as high-quality stocks. So this high-quality index is what you're seeing here in the top chart, and then what we'll do is I'm comparing it to what I would call this is another ETF, this SPHB, which is the high beta index, which probably has a little more of your riskier, you know, high beta type names. And sure enough, you know, going into the sell-off here in October, the high quality outperformed. You know, coming up here, even though the high quality is making all-time highs, and your high beta and even your S&P, is now finally making all-time highs, but still right near the previous highs. This has underperformed a little bit. What we're going to continue to watch here is if this continues to decline, well, then that tells us that, okay, maybe like we saw in the previous slide, okay, maybe some of your more cyclical names are starting to kind of get back in favor again. If we see this start to move higher here, then, again, it's going to continue to confirm that we want to be in high quality, we want to be in more defensive areas. One of the really good things that we have for us on stocks right now is that seasonality is favorable. So going into these last 3 months of the year, this is the strongest 3-month period of the year. This is going back to 1942. So that is a positive here for the market. I mean, it doesn't always work out that way, but, again, history doesn't always repeat itself, but many times it rhymes. So, so that's a positive for us there. A negative is that the value line index is still weak, and so what we have here is we have the S&P 500 here in this kind of blue and red, and then what we're doing is we are comparing it to, this is the S&P, and then we're comparing it to the well, this is the value line index compared to the S&P. So what the value line is the S&P is an index of 500 stocks, and they're market cap weighted, meaning that like Apple or ExxonMobil or Microsoft is going to have a much bigger weight in the index than, let's say, like a Regions Bank or something like that. But what the value line does is it's about 1,500 stocks, and then it equal weights them all. So it doesn't matter if you're Apple, it doesn't matter if you're Regions Bank, it doesn't matter if you're Dollar General, you all have the same weighting in the index. And so what that tells us is are all the stocks participating in this move? And really, even though the S&P has been moving higher, okay, those 500 biggest stocks, the value line has actually been dropping compared to the S&P, which tells us that in the average stock, meaning those 1,500, they aren't necessarily participating or as strong as we've been seeing the S&P 500. What you like to see is broad participation. As your market makes a new high, as the S&P makes a new high, you like to see a lot of stocks participating in that. Our building is right by a train track here, and there's a train that's going to be coming by. So if you hear some whistling, know that it's just the train coming by here. All right. And here's another thing, and we would consider this a negative too. Again, this is the S&P 500, and then this just shows us how many stocks in the S&P 500 are above their 200-day moving average. And again, as your index continues to make highs, you want to see this number stay up here, meaning that most of the stocks are above that 200-day moving average. But what's happened is we've been seeing a decline here over the past few months of the average stock above its 200-day moving average. So again, what's that telling us? What is pushing the market higher? It's probably more of your bigger market cap names, and this kind of gets back to that high quality, more of your big, more established, high quality companies are what tends to be outperforming right now. All right, so let's move on to just a few other markets here. This is the 10-year TIPS Treasury break-even rate, and just without going into all the details, it's one of our best indicators that we have for inflation. And what this is telling us right now is that inflation is expected to be less than 2%. So we are not in an inflationary environment. This is a chart of the U.S. dollar going back about almost 10 years. And the U.S. dollar has broken up out of a significant, we feel, a significant kind of resistance area. You had a little pullback here. Now the dollar's up even more so. That's actually up again today. So we believe that that we are going to be in an environment, at least here for a while, of a rising dollar. All right, this is oil, and if you remember on our last call, we've drawn a line in the sand here at $80 a barrel, and 110. And really, for the past few years, oil has kind of traded in this range. And just this week, we saw a breakdown below $80 a barrel in the price of oil. And if that holds, You know, I think oil could fall possibly to 70. I mean, I don't like making price projections, but so that is that's good for the economy. It's good for the consumer. It's bad for oil companies, obviously, but not all. But what really will probably have the most negative impact is the kind of U.S. energy resurgence, the fracking, the oil sands, things like that, Canada and U.S., that will have a negative impact on that industry there as well. Interest rates. So this is the 10-year Treasury yield. You know, everybody, we feel like everyone has been calling for higher interest rates, and this goes all the way back to the early 80s where we had, you know, that big top, you know, where a 10-year Treasury was yielding 16%, and so we've been on this really long downtrend since then. And in our opinion, until we see a move higher, until we actually see this line get broken, we feel that interest rates will probably stay lower. We don't see a spike up in rates anytime soon. You know, with inflation low, with that Fed balance, even though the Fed's not increasing their balance sheet, it's still over $4 trillion. All that liquidity that's out there, we think interest rates are most likely going to stay lower here for the time being. And when you hear a lot of people saying the same thing over and over again, interest, you know, they can't go any lower, so they must go higher. You know, sometimes you got to take a step back and say, well, let's see where we're at. Let's get some context on that. Where are we at in the big picture here? This chart here is, I thought I'd throw this in, just talking a little bit about home prices. And what's interesting here is this is the Case-Shiller Home Price Index. So what they do is they calculate an average of prices of the 10 biggest cities in the United States, and then they also have a composite of the 20 largest cities. So we all know real estate is regional, so you know what's happening in one area may not be in the other, but this is kind of the best thing that we have that just gives us an indication. Of course, you know, 07, 08, prices dropped, you know, spent the last few years bottoming, and now they've been moving higher. But when we look at the actual rate of change, what we're starting to see here is that rate of change come down here as it's been moving higher. So, you know, we hit that low here back in 09, you know, came up, came down, and then really over the past couple of years, we've seen a nice, you know, real estate prices have been going higher, but that rate of change is starting to slow down a little bit. So, you know, so it's not necessarily that the real estate market is turning, it's just that, you know, it's probably cooling down a little bit from how it's been over the last couple of years. And then this last chart, I know this is really busy, and I'll just explain a few things here, and what we look at here. This is kind of a what I like to call a heat map of all the markets. You know, we look domestically, internationally, we look at sectors, currencies, commodities, and just kind of lets us see, okay, what's really going on right now. And you know, we break everything down from a 1 month, 3 month, and then what has happened year to date. And so we use this for a number of areas. So, you know, if you notice here, look at the areas that have the most green: domestic stocks and bonds. You know, what areas have the most red? Foreign markets, foreign commodities, currencies, you know, is where you see a lot of the red. And one of our theses, because the Fed has been so active here in the United States than really anywhere else in the world, again, we believe that's one of the reasons why our stock market has been very positive compared to a lot of the other places in the world. And again, it's getting back to that first slide I showed you. It's because the Fed has been pushing it higher. One of the things that we like to look at that helps us show us if things are starting to turn, if things are starting to change. If you're looking at a longer time period here, okay, and you're seeing a lot of green, but maybe in the last month or so you're starting to see some red or some things turn or move down. Oops, excuse me. That would possibly show you, okay, maybe some things are turning, maybe some things are changing, maybe it's time to, really dig a little more into some areas. Like if you notice here, this is a good example. Japan just started their quantitative easing program again. They just kicked that back into high gear. Well, year to date they're down, but if you look over the last month, they're actually up. And so, this could be, sensing some, potential changes in here. China, surprisingly, has actually been, not only year to date, but even over the last month, we're starting to see some positives come out of China right now in terms of their stock market. On the fixed income side, long-term treasuries year to date, returned us 20%. That's strong for bonds. Of course, last year they had a bad year. You're looking on the currency side, again, this gets back to, we think the dollar's moving higher. Sure enough, it's been the best currency by far. So this just, again, confirms some of the other things, some of our thesis, and this is really kind of this last page here, is that we believe, high quality, growth-oriented stocks, interest rates are not likely to spike anytime soon. As we showed you, low domestic inflation, possible even deflation in some of the foreign markets that we're seeing. So, as long as you have a threat of deflation, I don't see how interest rates can move higher. Investments that thrive with a rising dollar is things that you want to look at. Defensive sectors favor, over more economically sensitive ones. We talked about that. And then, domestic is outperforming foreign markets really due to the quantitative easing program we believe that the Fed is doing. Now, they announced in the paper this morning in the Wall Street Journal that Europe is going to probably kick off another big round of quantitative easing. They've been saying that here for the past few months. There's still not a lot of clarity what that looks like, and will it be as strong, or what has happened here in the United States. So we're not too sure yet. But I'll go ahead and end here, and then we'll open it up to some questions from y'all. All righty. Okay. Who has some questions?